Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling and Sterling, Stephen Napolitano, The Wickoff Group, Urban American.
So there are things called private equity funds. These are the people who put out money, who make investments in all types of real estate around the country and around the world. So today I've assembled 4 of the most prominent local private equity who have investments around the U.S., around the world, to provide their insight on the market. My guests today include Scott Schwartz, the Senior Managing Director at Marathon Asset Management, Richard Mack, the North American Head for Aria Property Partners, David Welsh, the Senior Managing Director at Normandy Real Estate, and last but not least, Jeff Citrin, the Managing Partner and co-founder of Square Mile Capital. So since you were the new person on this group who hasn't been here, how do you see the world in 2011? Is it much better than 2009, 2010?
Gosh, that's a complicated question.
I know, but...
But
as it relates to real estate.
As it relates to real estate in the United States, it's still an over-leveraged asset class for properties and for companies that were financed during the bubble era.
So because it was over-leveraged, I hate to use the word assume, but I will use the word assume, you like to buy distressed debt.
Well, that's certainly a specialty of our firm, and that's been
Well, why do you like that? You know, you got to deal with these borrowers, you got to fight with them, You don't look like that type of guy who wants to beat him up. I mean, I'll bring Welsh, for that.
Well, I mean, we would bring in David and his partners as well also. But listen, we supply capital either to distressed lenders who need to unload their problems, and we will work to make a good return for our investors, or we will work with borrowers to recapitalize them on a consensual basis.
How, and this, I'm not only asking Jeff on this, are you able to work with borrowers today? I mean, is it easier, or they say, forget it, just take the property?
A lot of the deals we've done where borrowers been over-levered, many times they have recourse to the existing debt. And in order for them to get off the recourse, they're willing to work with you.
But recourse is fine if they own something. Mm-hmm. What if they're worthless? They sign this debt, what's the recourse worth?
It's always a hammer. Whether it's worth something or not, it's always a hammer. Nobody wants to go through a bankruptcy and ruin their credit. It's always a hammer that you can hold over someone. We did a deal in Florida where the borrower is completely over-leveraged, it's worth nothing. But he didn't want to go through the hassle. He handed us the keys, and and we had underwritten a Florida deal, take a year to get title. We got title in 4 months.
Richard, you've been active the last year. Tell us what you've been doing.
we didn't do as much as I think we ought to have done in 2009, but 2010 we were extremely active. 2010 was a year where we specialized in really preferred equity and mezzanine structures to help borrowers who were over-levered. And as far as direct acquisitions, we really focused on areas where we thought the fundamentals were improving, because we didn't see as many opportunities to buy distressed direct assets as we thought we would. So we focused on business hotels and on multifamily in the South. And I think both of those sectors we've seen that our prognosis was right. We've had almost double-digit growth in the hotel space in terms of rates and occupancy, and about 5% growth in terms of rents in the South generally, in terms of multifamily. So we feel pretty good. Wish we had done more in 2010. 2011 I think was more of the same, but it's more competitive in all of those landscapes. It's more difficult in terms of doing mezzanine and preferred deals. Spreads have come in, and it's more difficult in terms of prices in both the business hotel sector and in the multifamily sector. So we'll try to do more of the same in 2011, but it's a little bit more competitive.
David?
We have a little more targeted strategy. We're more specific in product type and geography than these guys. So we focus primarily in the Northeast, investing in
You
office
can't buy any
assets.
more towers like the Hancock Tower, can you?
That fits that's our perfect poster child of what we're trying to do with our fund, where we acquire primarily distressed note positions or distressed equity situations, office product in the Northeast and a little bit in California, and we're a fully integrated operating company. So, like we have the expertise like Jeff's firm does on the debt side, but our real advantage is we have a full team of managers, construction, development.
But here's the interesting item. I think it was Paraquin or one of the surveys that I read or I wrote about. Of the major funds raised last year, 9 out of 10 were for distressed debt. So you're competing with the Craig and maybe the Scott. Richard said he's not really looking at the distressed.
I don't think I'm as facile as these guys. I'm having a hard time finding it.
Right.
We're more down on the local level. So we're focusing with typically smaller
You don't want to buy some
situations.
debt in Indianapolis? I mean,
We like to stay where our relationships are, and so we have long-term relationships in the Northeast markets, and so we kind of troll in those situations where we can utilize our team's capabilities to create value the old-fashioned way by leasing space, redeveloping the property, repositioning the property, and not just relying on capital markets momentum.
now you bought bank portfolios.
We've bought 3 portfolios in the last year. I mean, we're really more focused on allocating capital throughout the country and up and down the capital structure. We're not integrated owner-operators, which is really David's firm's specialty. The 3 of the rest of us are really more agnostic about what we do as long as it's smart.
I had your partner about 2 years ago on the show, and he said to me it was his first investment that he made in 2 years. He bought a shopping center in Texas, I think for like $40 a square foot.
Yeah, you must be talking about the West Oaks Mall, which very interesting case study. It must have been in December.
It was.
A year and a half ago. We're in the process of building a new 14-screen theater that we just signed a lease on one of the vacated anchors. We paid $15 million for this 1 million-foot mall that had traded last 5 years ago for $102 million. It clearly wasn't worth $102 then, but it's clearly not worth anything close to $15 million right now.
Now, but how do you look at retail? I mean, you've had retail. How do you look at retail around the country?
Well, I commend that play, and
We were very lucky. That was a trough kind of
That was a great
investment.
buy.
I think that was a great buy. We're a little risk adverse when it comes to retail. We like the grocery anchored space because we feel that consumer convenience shopping, established shopping patterns if you can underwrite them well and understand them, particularly grocer anchored, are a good, safe bet, and there's a relatively strong positive spread that you can find. And generally, there's still a significant amount of lease up in terms of shop space, which is weak across the country, that hopefully can improve your returns. But we try to stay away from power centers and malls for two reasons. In the power center space, there are about half the amount of tenants as there used to be prior to the crash. And in the mall space, we think it's a place where the outcomes are very binary, because if you lose the anchors, the co-tenancy clause means that the whole center can go dark. And if you're not one of the major mall owners, you're really, the only thing you can bank on is the location. You don't have leverage with the tenants. So there are great opportunities in those spaces, but we don't love the risk reward, and there are going to be guys that are going to make 10 times their money on deals, like Jeff's going to do, and there's going to be deals where they're going to lose 100%.
Right, but you make a lot of very good points. Each of the risks you point out, we analyzed swiftly and decisively, but at the end of the day, we bought it for scrap value in case all of our modeling did not come true.
Well, again, it's a very good deal.
Now, didn't you make some loans on some shopping centers, even locally? I think you did something on Route 18 in East Brunswick.
Yes, we did. We made a loan to a regional bank had a construction loan on a to-be-built power center. It was anchored by Toys R Us and Babies R Us, and only built Toys R Us and Babies R Us. Had another 92,000 square feet to build, and we made him a new senior loan with some good news money to sign new leases and build out the balance of the center, while he negotiated with his bank for the discount, and then just kind of took some of the risk out of the equation. He had two new tenants in his pocket at at new rates and at his reduced basis. So we kind of hit the ground running with these two new tenants, and since we closed, he's kind of 30% built on the new 92,000 square feet and about 90% leased. So.
And what type of pricing do you charge for
your
loan?
That was a mid-teens return for that new senior loan. And that's construction risk, and it had some lease-up risk.
Now, you've done a lot of, last year I think you made some loans on some prime property on Madison Avenue. What type of pricing do you see, or if you're making that type of loan? I know everyone else might be looking to do some loans also.
Yeah, we put a $150 million preferred equity position from $350 to $500 million at 650 Madison, and we were able to get a 13.5% rate and a 4-year lockout. But I don't think that deal is replaceable again in today's market. I think that building is probably, they're out trying to sell 50% interest at it and well over $800 million. So I don't think that deal is replicable again. That's why I say that in 2011 we'll try to do more of the same type of deals, but I think it's just a difficult environment to do it in. We also made a loan from 40 to 50% on the Aventura Mall at a double-digit rate, which again I don't think a deal you could get done again. And really, what we were doing last year was not necessarily buying distressed debt, but taking advantage of people who either had distressed portfolios and needed to get cash to those deals and wanted to borrow against their trophy assets, and or distress within a particular trophy asset. I think that those, again, I'd love to do more of those deals, but going to be hard to achieve the same type of returns for similar risk in 2011.
There's an ephemeral capital strike. Most lenders or bond buyers were just not making loans, and Richard astutely jumped in and made superb risk-adjusted returns.
Well, I think like you, I want to say lucky, but we were both probably in the right place at the right time.
What about the office market? How do you look at the office? You own buildings, you've bought buildings, you've taken over buildings.
We see a lot of opportunity in the office space right now. I think the multifamily and multifamily sector is kind of stabilized a little earlier than the office. A lot of the office loans were originated in the 07 vintage, and there's going to be a lot of loans that are coming due that are definitely underwater. Probably 50% of commercial mortgage loans that are coming due this year and next year are underwater. So in the in the past 24 months, banks have been reluctant to push those loans off their books, and they've been playing the extend and pretend game, and that's starting to change. You're seeing trades happen now. Banks are making more money today, and
They can afford to.
and the values have come up, so now they can hit a little. They've marked down, and they can actually exceed those marks today. So you see some big trades. Barclays just sold a big portfolio to Crexus. You're seeing, Wachovia is selling a lot of loans off their books, and that you're going to start seeing a lot more opportunities and more supply coming onto the market. Where right now there's just really been a dearth of opportunities in that space, which I think is attributed to the pent-up demand and all the competition on a lot of these big deals.
But the market is improving not everywhere. I mean, New York, Washington, maybe San Francisco, maybe Los Angeles, parts of, I'm not sure about Chicago because you can always build more property in Chicago. So suburban office isn't that great. Even unless you can get a property for $40. I mean, I wrote an article. It was great because APF Properties bought a building on 44th Street for $450, and then they bought a building in Wayne, which I'm certain you looked at,
Right.
and they paid about $87.
The New
It's
York
really a
City
story
one
of the
was
have.
cheaper relatively.
It was.
It's a story of the have and the have-nots as far as markets are concerned. CBD, New York City being the premier market, Boston, D.C., San Francisco, L.A., and then, like you said, these suburban markets. I mean, to play in the suburban markets, it's all about basis. You can make money, but you can't count on rent growth. You can't count on job demand. It's all about buying cheap, 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 being able to steal tenants from other buildings, and you can make money by
As
playing
you
that.
and I have said on this show, the only person who makes money in certain suburban markets like Westchester and New Jersey is the office leasing broker who's moving some tenant from one building to another building.
Well, I hope that's not true because we have some investments in those markets. But I think, like I said, it's all about where your buy is.
What about we were talking about this, there's this group called the Sovereign Wealth Funds. Now, recently the Australian fund just came in, first investment. They're the 16th or the 17th largest sovereign wealth fund around the world, and they invested with TIAA-CREF on 685 3rd Avenue. Do you see a lot of foreign investors? You see a lot of people coming to you, Israelis, sovereign wealth funds, and others, Chinese, saying, I want to do business with you? Scott, Richard?
I think there's an appetite from certain sovereign wealth funds, but Richard mentioned it earlier that they're most of them do not want to invest in commingled funds anymore. So they're either in co-invest mode or want their own managed account or their own fund of one to invest with you.
I think that's absolutely right. What I would say is they also want to own trophy buildings, and one of the reasons that the CBDs are a bit overpriced, and particularly only the primary CBDs, is that there's just too much capital chasing too few buildings. And it's not just the sovereign wealth funds that want that, it's also the core funds that want it.
And it's the REITs.
And the REITs.
And the REITs are very, they have a lot of money. So, you're competing with funds and you're competing with the REITs.
So classify all of those categories as core investors, which is very difficult for private equity investors to really compete with, unless our underlying clients want us to make
here's a
single-digit
question.
returns.
I was interviewing a friend of mine because I was going to do his life story, and he said 30 years ago, you were able to talk, a broker would bring you a deal, and you were the only one who might have seen that deal. Today, there's no one broker. They show it to 400 people. I mean, how do you get a deal? How do you find the transaction? I mean, is there anything off price, off market? I mean,
The deals we've done and have been mostly relationship driven. I think the loan sale advisors have done a spectacular job of marketing the collateral that they've sold to date and gotten prices well above what the sellers probably expected. And
that's on loans.
Yeah.
But what about assets? You bought property, you bought hotels, you bought apartments, you bought properties. I mean, where are they coming from? How are you finding them?
It's very hard to do off-market deals in the U.S. market. It's a very competitive market. Last year we did one off-market deal. There was a seller who thought they were going to change the tax law, woke up one day and said, I need to sell. 3,000 apartment units in Texas in 45 days. That's a very unusual circumstance. I don't see that very often. But the reason that we like preferred equity and mezzanine deals is because they can get structured in a way that is a little bit away from the market. We're not getting a lot of upside, but we're not necessarily competing with 20 people because these deals are so highly tailored to the borrower that we can find a way to do things that are slightly off market. But it's very hard to find the off market deals, and to the extent that you can find them, they're generally pricing a little bit better, but it's hard.
There's no reason in the world that someone who is voluntarily selling a real estate asset, a 100% interest in it, should do anything on a direct basis. They should go to the brokerage community and find the highest payer.
And it relates to distressed debt. A number of banks who I'm friendly with, they were selling it themselves, and then some of them said, hey, if I don't show certain regulators, the banks who are under cease and desist orders or something else, if they don't have a broker, they say, you haven't really done your job in many aspects, that you've given the opportunity to more people.
It's hard to disagree with that.
Right.
That's one of the rare cases where the regulators seem right.
I think the loan buys, although now they're being very, they're marketed a lot by brokers. There's less competition for the loan buys, and I think in some cases it's still easier to cut a deal with the borrower. So you are seeing private negotiations between a lender and a borrower, and that borrower may not have the capital to do the deal. So there's an opportunity to do a privately negotiated deal with the borrower through a loan.
So when you make a private deal with a borrower, what do you have to do? What kind of deal are you making with them?
It's like an example. We were, in a situation where we had a loan was not in default. It was cash flowing, servicing the debt, but it was clearly underwater, and it matured in 2 years. So and reserves to lease up the building had been depleted. So the lender could go out and market the loan position, but people that were looking at that position had to make an assumption of what the collateral would look like after 2 years without leasing, and then a 2 to 3 year mortgage foreclosure process in New York that was going to really hit the value of that loan position. The borrower, on the other hand, could pay the lender a number that was equal to the real estate value today and recapitalize the deal. So it gave the borrower an ability to pay more than anybody else, and the lender recognized that and did a direct deal with the borrower.
Now,
I would say something. I was going to add one more thing.
Sure.
We believe in doing a significant amount of trend analysis and research, given how competitive the market is. And in a competitive market where things are widely flogged, for lack of a better description, you have to have some type of information, right or wrong, to allow you to buy at market. So you have to either believe that rents are growing more than people think they're going to, or that capital market flows are going to be greater than people think. You have to have an expectation that allows you to buy at the market and succeed. And that's what we've really focused on doing. So I think that you can still make money buying at the market if you have done enough research to make a compelling bet.
Or if you haven't done the work, but you turn out to be right for other reasons.
That's a good thing too. That's maybe better.
Now, but we were talking. Scott brought up before, about a failed condo that he bought over there in Florida. That's been an item. A lot of people have been buying failed condos, and in certain markets, they've really done well. I've seen it in the Williamsburg market in Brooklyn. I've seen it in certain other markets. While in downtown Brooklyn, buying a failed condo in downtown Brooklyn hasn't been the greatest market.
Again, it gets back to price. If you buy it, even bad real estate, at a price that's lower than its intrinsic value, could be a great buy. And overpaying for the nicest trophy in the world can be a disaster.
What about land? Do you think, I'm not sure who brought it up prior to the show. We were talking, maybe it was David, maybe it's time to buy land and to build a multifamily because certain people aren't buying houses. Is that something that, that you would do in your private equity funds?
We're looking at it now, seriously. We wouldn't go spec, and we're not. I think it does make sense to develop multifamily, although that's not what we do. But we're looking at a few situations in Boston and the Washington, D.C. area, prime land sites that over the long term, are going to be extremely successful. And as long as you don't finance the land and you have the right capitalization, I think now is a good time to be buying land.
It
Richard?
has to be your business. It's just not our business to do that.
Yeah, we're looking very seriously at multifamily development. We're not looking at multifamily land per se. So what we see right now is an arbitrage between what development yields appear to be, and I don't think I've done enough research yet, although I'm working very hard on this to be completely convinced. But there seems to be a 200 to 300 basis point arbitrage between where you can build and where these assets are selling. That's an unsustainable arbitrage in our mind. But to be able to capture that arbitrage, you have to get in and build very quickly, which means you really have to buy something that is ready to go. The plans
With
are
the
there.
approvals are there and everything.
Correct. So I don't think we're ready to buy land even for multifamily that's not totally ready to go. But multifamily is the one spot that we think is perhaps has a big enough spread between where stabilized assets and development yields are.
So in the conversation, I've heard hospitality, office, retail, multifamily. I haven't heard two other areas.
You covered
Industrial.
most of the food groups.
I know. What about industrial? What's your thought about industrial?
It's hard to make opportunistic returns in industrial real estate. You can make a good timing bet, and there's some large aggregators right now, but it's generally a low teens levered return in that sector.
I would agree. I mean, we're looking at a couple of opportunities where we're making a new senior loan on industrial, but we haven't found any investment
How
opportunities.
small of a deal would you entertain? Have a loan or an investment?
10 million is a small deal.
Richard?
25.
10.
10?
We're 15 to 20 million is probably our minimum.
So, I think my audience and I have got a pretty idea that you guys are in business, cautiously optimistic, that you'll raise money, and it's an interesting market. And I'd like to thank Scott Schwartz, Richard Mack, David Welsh, and Jeff Citron. See you next week.
Major support for these programs is provided by Bank of America, Merrill Lynch, and Perfect Building Maintenance, New York Community Bank, All Nation Renovation, Kilroy Architectural Windows, New York's Window Company, Greenberg Traurig, LLP, M&T Bank. Additional support is provided by AVR Realty Company, LLC, Ackman Ziff Real Estate Group, LLC, Bingham McCutcheon, LLP, Briarwood Organization, Capital One Bank, C.B. Richard Ellis, James Orphanides, Centurion Holdings, Cushman & Wakefield, Dimes Savings Bank of Williamsburg, Douglaston Development, DDG Partners, Eastern Consolidated, Hal Fettner, Durst Fettner Residential, Friedman, LLP, Accountants and Advisors, Gemini Real Estate Advisors, LLC, Genova, Burns and Gian Tomasi, Grubb and Ellis, Investors Savings Bank, Jack Jaffa and Associates Real Estate Consultants, James D. Kuhn Real Estate Institute at Syracuse University, Madison Realty Capital, Massey Knackle Realty Services, Meridian Capital Group, Margolin Weiner and Evans, LLP, Certified Public Accountants and Business Advisors, Newmark Knight Frank, RAL Development Services, The Spandrel Group, LLC, Siami Development, SJP Properties, Site Comply, Sterling and Sterling, Stephen Napolitano, The Wickoff Group, Urban American.